I know, and it's really a process of deduction, that China has accumulated extremely large stocks of gold, which are, as it were, off balance sheet. I think that it's in excess of 30,000 tons. It could be even more than that. And that's in the States. They then advertised after 2002, when obviously they got together as much gold as they felt they needed to secure the value of the yuan. I think that's a very good point, because what we're talking about with the Monroe Doctrine is actually in addition to the problems we had before. And to summarize that very, very briefly, what we're dealing with is the twin deficit syndrome. Unless you have an increase in the savings rate, what happens in accounting terms is that a budget deficit becomes reflected in a trade deficit. Now, if what you do is you restrict imports, if you like, as a means of trying to, for whatever reason, you don't like China or you don't like whatever, or you were trying to protect domestic industry, then actually, if you work it through, the consequences of that are higher prices. It must be. And I know, I've read so many economists, who, quite frankly, I don't think deserve the label of economists, who are saying that, well, there's been no inflation from Trump's tariffs so far. Hold on a minute. Don't these guys understand the Cantillon effect? This is something that takes about 18 months, year to 18 months to work through. And I tell you what, we've now got a dollar crisis. We've even got President Trump saying he doesn't mind a lower dollar, which I saw as a headline this morning. And on top of that, you've got all the disruption from, if you like, the supply chains being disrupted, and at the same time, these extra tariffs. It's going to result in a collapse in the purchasing power of the dollar. It's actually quite simple. So that is additional. I referred earlier to the fact that if you look at commodity prices measured in gold, which over long periods of time should be stable, and they are stable, history has shown that, though there can be ups and downs. So far what's happened is that because we've been pricing everything in declining dollars without realizing it's the dollars declining, we've seen commodity prices begin to rise, yes, but priced in gold. I actually looked at copper this morning. Copper is priced at around about 15% of its long-term gold value. Now, this implies that copper could easily rise 600%, 700%, just measured in gold terms, let alone in depreciating dollars. This is an extremely serious situation.
When commodities are measured in gold rather than paper currencies, a different picture emerges. Historically, commodity prices remain relatively stable when priced in gold, even across centuries. Today, many key materials remain deeply undervalued by that standard. Copper, for example, trades far below its long-term gold-denominated average, implying enormous upside if historical relationships reassert themselves. This suggests that rising prices may not reflect scarcity alone, but currency depreciation. As costs climb and bond yields follow, heavily indebted businesses face mounting pressure, setting the stage for wider financial instability.
And if we just digress slightly, this is obviously going to lead to far higher bond yields. It must do, for the reasons that I've stated. What then happens is that you find that businesses, over-indebted businesses, start going bust. You might have banks in trouble, and so on. You could well have trouble in the derivatives market, which you could easily extrapolate from what's happening, what we already see. Now, under those circumstances, the authorities in America, to wit the Treasury and the Fed, have one simple duty, and that is to stop the whole system falling over. So what are they going to do? They're going to print. The budget deficit that we see today, which looks like it's working out about 2.5 trillion, is going to be more than that by a huge, huge number potentially. So that's the sort of background. Now let's just look at silver for a moment. In geopolitical terms, this is interesting because I've been reading, and we mentioned it before we started this interview, that there's just so much silver around. The retail market. People are, trying to sell their coins. They're trying to do this. They're just dumping silver everywhere. All these wonderful high prices, having been disillusioned, if you like, for so long. I can understand that. But the problem, I think, for any intermediary, any bullion dealer, is that there isn't the refining capacity to recycle this stuff. And not only that, but if you look at coins, which have other base metals in them, the recycling process is not a one-off. You've got to do it several times in order to get pure silver. The margins in this are not all that great. And the refiners just don't have the capacity to take this on. That's why it's all clogging up, if you like, in America and also in Europe. But go to Asia and bear in mind that, when I was a young lad in the Middle East, the Maria Theresa dollar in the 1960s and 70s was still circulating as a means of payment. Silver Maria Theresa dollars. They were being produced by the Austrian mint in huge quantities because there was the demand for them. And then in China was last on a metallic standard, which so happened to be silver.
Rising yields and slowing growth create dangerous feedback loops. Over-leveraged companies begin to fail, banks face balance sheet strain, and derivatives markets become increasingly fragile. In such moments, policymakers have a singular priority: preventing systemic collapse. The response is almost always the same: liquidity injections on a massive scale. Deficits expand, central banks intervene, and money creation accelerates. What begins as emergency support quickly becomes policy. This backdrop explains why hard assets draw renewed attention. When trust in financial stability erodes, the instinct to seek tangible value returns.
And that they came off that, I think, in 1935, 37, round about then. So, okay, it's been some time, but I think there is a far greater natural affinity in Asia with silver coinage, silver, if you like, as real money, in the practical sense, rather than gold. So this raises an interesting question because what we're immediately seeing is we're seeing the price being driven not in London or in New York. We're seeing it being driven in China and also India, where the premiums are up to 15% over ours. And you would think that there would be some arbitration, but arbitrage rather. It doesn't seem to be happening. We don't seem to be seeing any arbitrage at all. Not enough, certainly, to dampen the price. Which really means, I think, the new licensing system, if it was designed to restrict silver exports out of China, then it certainly appears to be working. So I think that's the important point to realize. Last night, we've got silver, I think at the moment, my screen's sort of gone dark on me, but I think we've got silver around about 15, 16, something like that. It closed last night in Shanghai at 130 equivalent. So that gives you an idea as to exactly where the pull in the price is coming from. Now, in my article, which you referred to earlier, I stated that I thought that what we were looking at was a new sort of version of Bretton Woods with gold being exchangeable for yuan at a fixed rate for the purposes of international trade settlement, which is roughly what happened with Bretton Woods, if you like. This leaves the question as to how do you fix the value of the yuan domestically? And I think that the original thought in China was that they would go back on a silver standard for the domestic market. bear in mind that they've got exchange controls, so they can ring-fence the domestic market from international settlements. So it's perfectly possible for them to have a gold standard, if you like, for trade settlement between nations, and at the same time, a silver standard at a fixed rate for domestic purposes. That, I think, would work very well.
While Western markets debate supply, the real story in silver is unfolding in Asia. In China and India, silver carries deep cultural and monetary significance, rooted in centuries of circulation as real money. Today, prices in Asian physical markets command substantial premiums over Western paper exchanges. Arbitrage should close that gap, but it isn't. Export controls and licensing systems appear to be restricting flows, keeping physical silver anchored in the East. This shift suggests pricing power is migrating away from London and New York toward markets where physical demand dominates.
The interesting thing is that I know, and it's really a process of deduction, that China has accumulated extremely large stocks of gold, which are, as it were, off balance sheet. I think that it's in excess of 30,000 tons. It could be even more than that. And that's in the States. They then advertised after 2002, when obviously they got together as much gold as they felt they needed to secure the value of the yuan in a gold standard. They then encouraged ordinary people who before then had been banned from gold ownership to rush out and buy gold. And sure, they bought roughly 28,000 tons. So you can see there's a lot of gold, if you like, in China. But it begs the question what they've been doing with silver. Now, I know, I worked this out when I was speaking at a conference in New York back, I think in 2011, 2012, something like that. And there were lots of silver miners exhibiting, if you like. Obviously, it's all in the business of trying to find, more capital and all the rest of it, because with the low price of silver, it was quite a tricky business. But I asked them all the same question. I said, how do you turn your silver into currency to pay your wages, pay your energy bills, and all the rest of it? And they all said exactly the same thing. They said that the value of the Dory is agreed by an independent valuer, who would be Glencore, for example. And on the basis of that, payment would come from a US bank. Now, this was obviously JP Morgan. What JP Morgan would do was it would pay the silver miner on the valuation. The silver Dory would then be shipped to China to be processed, because processing is a dirty industry, and we sort of rather soft Europeans or Anglo-Americans don't particularly like this sort of...
Not in my backyard, yeah.
Not in my backyard, exactly. So China was basically taking all this stuff in, plus, of course, refining ores of, copper, lead, zinc, and all the rest of it, where silver is present. I mean, it's something like 60% of silver mined actually comes from as a byproduct of these other metals. China was doing it all. And so not only is she the second largest miner of silver in the world after Mexico.
For decades, China has played a central role in silver processing and accumulation. As a major refiner of silver-bearing ores and door bars, it has absorbed enormous quantities of metal. Western miners often relied on financial intermediaries to convert silver into cash, with the metal ultimately refined in China. During this period, futures markets helped suppress prices, facilitating accumulation. This strategy unfolded before today's surge in industrial demand from solar panels and electrification. Now, with domestic needs rising, China appears far less willing to release silver back into global markets.
But if you take into account all the Dory and also all the silver coming out of the other ores which she is processing, she's the largest processor and accumulator of silver in the world by miles, absolutely miles. So what this means is that for the last I don't know, 20 years or so, she has been accumulating huge amounts of silver and using JP Morgan, if you like, to control the price which she pays by selling futures on COMEX, and for all I know, forwards in London, but particularly futures on COMEX, to keep the price down. And this led to rumors, of course, that JP Morgan were short of silver and they were controlling the price and all this sort of stuff. Well, yeah, they were controlling the price, but they weren't doing it for themselves. They were doing it for the Chinese government. That much is clear. So they have accumulated enormous stocks of silver. This was all, this was really before photovoltaics and electric vehicles took off. And I'm convinced that the original thinking, but bear in mind that the responsibility for all silver dealing, if you like, in and licensing and all the rest of it is the People's Bank of China, just as they have, if you like, the monopoly. They are appointed, if you like, by the government to handle all gold transactions as well. So, what's now happened, of course, is we've now got huge industrial demand. But I guess that we're now at the juncture where China is going to be very, very careful how much silver she lets to leak out into the West, for the very simple reason that she needs it herself for two purposes. Firstly, for potential monetization, and secondly, to feed into industrial activities. So where does that leave the silver markets? Well, the interesting thing is that the Chinese people are now buying this big time. Indians are buying it big time as well. You can forget the stories about how, poor Americans and Europeans can't get anything for less silver scrap. I mean, that's not the issue. It really isn't. It doesn't matter as far as the silver price is concerned. There is no silver. And the interesting thing is that if you look at the statistics coming out of COMEX in terms of open interest, in both gold and silver, incidentally, and also the commitment of traders figures, you see that the amount of speculative buying is very low. This is all real stuff. This is a squeeze on the system. And so we have basically the prices being forced up by China, no longer supplying the West in the quantities which it has been prepared to do before. And in the West, I'd also include her own SCO members, such as India, who are now big consumers. And this is creating a crisis. And it's got nothing to do with speculation. So the idea that you see the silver price rising and, it's being driven by, sort of bulls and momentum traders, no, it's not at all. What's actually happening is you have got a systemic squeeze, which shows no signs of ending. And it also is probably becoming a GIF-end good. In other words, a GIF-end good is one which, when the price rises, instead of it creating demand, the rise in price restricts demand because people don't want to sell it because they think they'll never get it back. So you can see that this is the worst of both worlds, I think, as far as the swaps on COMEX and the bullion banks and the hedge funds, if you like, who have been short on the forward market, is the worst of both worlds for them. The squeeze continues.
The current silver rally shows little sign of speculative excess. Futures positioning remains modest, and retail activity plays a minimal role. Instead, the market is tightening due to physical scarcity and strategic hoarding. As prices rise, holders become reluctant sellers, reinforcing the squeeze. This dynamic resembles a self-reinforcing loop where higher prices reduce available supply rather than destroy demand. The result is pressure on institutions that once relied on abundant liquidity. What's unfolding is not a temporary surge, but a structural shift, one that may redefine silver's role in the global monetary landscape.